Hi, I'm Russ Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by managing director and technical strategist Todd Sohn. Todd, how are you doing this morning?
Hey Ross, I'm great. Always a pleasure to speak with you, bud.
Yeah, good to talk to you as well. We'll plan to hit a couple of topics today. I want to start with what to me seems like the biggest or most widely accepted near-term risk, which is people are just too bullish. People are very excited post-election. A lot of sentiment indicators are flagging pretty hot. I know you do a lot of work in that area. What are you seeing? And then what should the average investor even do with that data? How should we think about sentiment as a risk?
Yeah, it's a great question. And first of all, remember, sentiment can persist. Aggressively bullish sentiment can persist for longer than we may believe, right? It's not a great timing tool. It's actually much better timing at bear market lows when everyone is super pessimistic. And so I think if you're a longer term investor, you may see a speed bump when attitudes get frothy, right? A pretty decent shakeout. The average S&P 500 year sees about a 14% drawdown. So the data we're looking at is equity ETF flows have run pretty hot, especially as you mentioned post-election. Very confident attitudes. You're starting to see survey data really perk up in terms of bullishness. And the options market still tends to skew towards the call side of things. And so there are aggressively bullish attitudes. But again, you can't really time this. It's just something more to be mindful of saying, hey, maybe the market's gotten a little stretched in the near term. You're still going to want to use any sort of shakeout in the first quarter of 2025, I believe, to continue to add equity exposure. Stay in the game. Don't worry too much about hot sentiment ultimately in the long run.
Yeah, I think I've heard you all say it before. I mean, ultimately, a bull market needs bulls, right? If everyone was bearish, then who's buying the stocks? But speaking of sentiment and maybe the opposite of what people are feeling in the US is I think how people feel about investing internationally and Europe in particular, sentiment is pretty dour. The returns have not been spectacular, so that is probably the right way to feel about it or has been in recent memory. I know you've done some work on Europe recently. What are you thinking about Europe and international in general heading into 2025?
Yeah, it feels like, do we even need international anymore? That's what you and I were talking about. And I would sum up Europe this way. There have been basically zero new product launches from the ETF side of focused on Europe over the last 6 years. Outflows from European equity ETFs have really picked up, so investors are throwing in the towel. I think if you wanted to look internationally, the reason to have it is at least some diversification, right? The US is very tech heavy, it's very growth heavy. Whereas if you invest internationally, whether it's Europe or even Japan and Asia, you're going to get more financials, more staples, more industrials. And so there's just this diversification aspect to why you'd want to own the international. I am cognizant that the MSCI ACWI is approaching about 70% US and Canada. So that's very heavy on the US, and especially if you own that along with the S&P 500, along with large cap growth, that's a lot of exposure to a small cohort of names. And so I am cognizant that international diversification hasn't worked out, but I think at some point it may come to matter and it may help smooth out some of the speed bumps we can expect from the equity market.
Yeah, I totally agree. One of the things I usually point people to who are getting ready to throw in the towel is that even this century, right, 2000 to 2009, international diversification would have helped what was a lost decade in U.S. stocks. So we don't even have to go back that far, but obviously it's been a rough 10 to 15 years here. Let's end back in the U.S., looking to 2025. Your general disposition on your sector work, right? What's working, what's not, and what does that say about the broad market as we turn the page on a new year?
Yeah, excellent question. So what's working? Financials are ranked first in our technical sector rankings. They have great absolute trends, great relative trends. Are they a little bit overbought? Yes. Probabilistically speaking, when you get strong trends and overbought conditions, you're going to want to use any sort of pullbacks to add exposure. I think healthcare is a really interesting space only because the healthcare sector itself is basically taking a GLP-1 drug. It's gone from 16% of the S&P to 10% over the last 2 years. That is a massive drop for a significant weight. You've seen healthcare sector outflows really accelerate this year as performance has been challenging. And so I think if you're looking for a contrarian area, away from financials, away from some of the more cyclical areas, healthcare is interesting from that perspective. Does not quite have the momentum we want to see, such as coming from the financial sector or even software within technology. But if you're just looking for something else out there that is not large cap growth, take a look at healthcare. I think that's a really interesting spot. Let's just see if this sentiment can finally turn and we can finally get some demand back into that space.
Well, Todd, this has been great. A lot of things to watch heading into the new year. Appreciate the time as always, and happy holidays.
Hey, you too, Ross. Thanks a lot.